that a guest joining us now, Nilesh Shah of Envision Capital, now joins in. Nilesh, hi, good morning. We've reacted a lot to noise of late. A lot of this is noise in terms of Greece, China. What's your call in terms of how we'll react to further news from Greece and China? Is the risk of collateral damage still intact?
Yes, Anuj, thank you for having me. Clearly, I think these are real short-term risks, and we clearly believe that on one hand, there are risks to the marketplace, because clearly the developments in Greece or China, and if that coincides with a rate hike by the US Fed, could create some kind of volatility in the marketplace and could create its own set of collateral damage, which could potentially want some of these emerging market funds to kind of take some money off the table. So to that extent, I probably think that there could be a downside if a combination of these three catalysts together create some kind of volatility on the downside. So to that extent, I probably think that from a pure market point of view, there are short-term risks and there could be potential volatility. But on the other hand, what it is really doing is it's doing something really fundamental for the economy. It's basically correcting commodity prices. Commodity prices have declined significantly. And I think this really bodes well for India and India's economy. And to that extent, some of the macro variables like inflation and deficits get capped. It gives some elbow room to the government to streamline subsidies and have resources to fund its infrastructure projects and step up public investment, which in turn should basically lift up growth rates. So to that extent, I think on one hand, these developments are negative for the markets, but I think they're really positive for the Indian economy and corporate India.
Okay, and I take your long-term positive point, Nilesh, and that's something that we have discussed as well. But let's talk about the near term first, because clearly the market has seen a bit of an iffy trend. In the near term, do you think the Nifty will hold the recent 8,000 low, or do you think the combination of all the negative news will take the market below 8,000?
Well, it looks like that these levels of 8,000 or the recent lows should provide a reasonable base to Indian equity markets. Actually, on a fundamental basis, those levels of 8,000 actually make the markets very, very attractive, given that we believe that an earnings recovery is imminent in the second half of this financial year. However, if the developments in Greece or China turn more uglier, and if that actually coincides with a rate hike by the US Fed, we could momentarily slip below the 8,000 level marks. But I don't see the markets going down substantially below that. You could, on an intraday basis or an intra-week basis, maybe go to 7,800 levels, and you could technically say that the markets have made a new low. But I don't think those new lows will be substantially lower than the recent lows that we have seen between April and June. So to that extent, I probably believe that those levels of 8,000 should hold unless there is a significant collateral damage. But nevertheless, at those kind of levels, there is strong fundamental value emerging, and we actually do not believe that the markets are going to stay significantly below those levels of 8,000 for a very long time.
Okay. Nilesh, do you think that the monsoon is going to be a risk factor in the near term, simply because we have seen a slowdown in its progress?
Well, we actually believe that, yes, the monsoons are important, given that farm incomes and the rural economy have been the mainstay of India's growth journey. But we really do not believe that it's going to have a very, very significant impact. Nevertheless, from a sentiment point of view, it could have some impact. But nevertheless, I think for the next 2 or 3 months, it will remain an important variable. The second, and I think which perhaps is even more important, is the impending elections in Bihar. This is going to be an interesting political battle, and it has certain economic implications. If the NDA does extremely well in Bihar, then I think that's going to give a fillip to this government to accelerate the pace of economic reforms, and it could pave the way for passage of bills like the GST bill and the land acquisition bill and a lot of the other legislations which are lined up. But on the other hand, if the NDA does not do well in the Bihar elections, it could pretty well, in a way, slow down the pace of economic reforms, and that's something which could clearly be negative for the economy, and if at all, it could even be more negative than a lackluster monsoon. So clearly believe that first is monsoon, but perhaps more important is the election battle in Bihar.
Okay, Nilesh, in fact, that's an interesting point. Do you then think that Bihar would be a binary event for the markets?
It could, because I actually believe that the Bihar election is pretty much going to be like a slightly moderate version of the 2014 general elections in India. The way 2014 elections changed the mood and changed the sentiment and changed the direction of the markets, to an extent, the Bihar elections could be some kind of a moderate version of that. Of course, it's not as big an event as that, but it could be a moderate version of that. Because around the Bihar election are 2 or 3 events which are equally lined up. One is, of course, a potential recovery in the earnings cycle in India. And I think if for some reason the pickup in earnings cycle gets postponed, it's actually the Bihar elections which could actually limit the downside for our markets. So one is that, and two is basically potential rate cuts by the RBI in the fourth quarter of this calendar year, which is possible post the correction in commodity prices. So I clearly believe that to some extent Bihar elections could provide a significant fillip to our markets, because we clearly believe that a lot of important economic legislations and the economic agenda of the government could get accelerated post the outcome of the Bihar elections in September, October, provided if the NDA wins, because that clearly means that the NDA then has an upper hand in terms of its equations with various political parties. So to that extent, I clearly believe the Bihar elections are going to be very, very important, both for the economy as well as for the markets.
Okay, so let's talk about earnings then, Nilesh. You did say that it will pick up at some point, but let's talk about this season, because the start from TCS wasn't exactly great, but not too bad also. So, in terms of IT stocks, how would you approach both TCS and the rest of the sector now?
Honestly, I think the TCS numbers were reasonably good given the kind of operating environment that's prevailing across the world. And I think a lot of the tier 1 technology companies are kind of likely to kind of mirror the performance which TCS has reported for the first quarter of this financial year. I think clearly some of the key variables that one needs to continue to watch out for is, can at least the frontline IT companies firstly have a low single-digit revenue growth? Number 2 is operating margins of at least 25%. Third is ability to win clients with those $50 million per annum run rate or $100 million per annum. If there's an accretion in that headcount out there in terms of the clients, I think that's going to be a key positive. And fourth is the ability to ramp up revenues from the digital arena and the opportunity which digital and its max presence to Indian technology companies. So clearly these are the 4 variables that we need to watch out for from the technology sector. It's quite possible that the first half of this financial year or the first Q1, Q2 could be a bit tepid, but we believe that technology companies are pretty attractively priced, keeping in mind the potential for the next 2 to 3 years. And we believe that the valuations are very attractive in the frontline technology companies.
Okay. How about private banks, Nilesh? For example, ICICI Bank has been quite a drag on the markets, down around 11% on a YTD basis. For example, do you think can they still maintain leadership?
Well, it still looks like that the leadership will remain with the private banks. The public sector banks have got a long way to go in terms of their balance sheets getting repaired. We clearly believe that the public sector banks require a significant surgical makeover, which does not seem to be around the corner as of now. So to that extent, till the public sector banks reforms is not unveiled for public sector banks and there isn't a surgical makeover, you're clearly going to see leadership remain with the private sector banks. But making money in private sector banks from here onwards is not going to be very easy. You could still make absolute returns, but I'm not too sure if they could deliver market-beating performance. Given that the valuations are very high, most of the quality private sector banks are trading, barring an ICICI Bank, which you mentioned, are still trading at 3 to 4 times price to book, which we believe is not cheap, which we believe is not reasonable. In the next 2 to 3 years, the competitive landscape is going to change. You're going to see a lot of new private banks come in, either in the form of payment banks or full-fledged banks, clearly who are going to have technology as their key USP. and their way to access customers and access markets. So to that extent, the competitive scenario for private sector banks is going to intensify further over the next couple of years. So to that extent, I'd probably say that private sector banking stocks could go through still an extended period of consolidation as valuations, as earnings catch up happens with the valuations. So I think one needs to be very careful about investing in private sector banks at these valuations.
Okay, fair enough. What are your thoughts, Nilesh, on FII inflows? Because we've seen it drying up, but it's largely mitigated or absorbed by DIIs. Do you think that the market could continue to remain being resilient to FII selling?
Yes, in the short term, liquidity is going to matter. And so to that extent, so far, domestic flows have been an excellent cushion against, slowdown in flows from FIIs. And we believe that inflows from domestic investors will continue. We clearly see that most of the domestic investors are still invested in Indian equities. So I think barring the caveat that there are going to be 40,000 crores of issuance of tax-free bonds, barring that, we clearly believe that domestic flows will be very, very strong. We also believe that the FI flow into India is likely to pick up post-September, as there is better visibility in earnings pickup, as the headroom for RBI to cut rates emerges, and three, of course, post the outcome of the Bihar elections. I think when you have these three events lined up together, our sense is that post-October you could actually see inflows from FIs begin to pick up.
Okay, Nilesh. So in that case, if we get the Goldilocks scenario of positive Bihar elections, low inflation, commodity prices remaining where they are, and FI flows coming back, do you think it's reasonable to assume that the market will make another move towards all-time highs before the end of the financial year?
I probably believe that the second half of this financial year, and more so the Jan to March quarter of FY 2015-16, which is the first quarter of CY 2016, I think the period from October to March should be very good on a full 6-month basis, given that the first half so far has been lackluster and that the Indian markets have been consolidating for the last 6 to 9 months. So I'd probably believe that the second half of this financial year could be a lot better. In terms of outlook, in terms of levels, obviously the nifty highs of 9,000 plus remain an important psychological barrier. But we clearly believe that if the outcome of some of these events which we discussed earlier are favorable, and there is basically a pickup in the earnings cycle, and if the government goes ahead with both step up in public investment and step up in economic reforms, we clearly believe that this would be an excellent, virtuous and a benign combination that could be confronted to Indian equity markets. And I think on the back of all of these, we won't be surprised if over the next 2 years from 8,000, 8,500, we move into the levels of 9,500 to 10,000 on the Nifty.
Okay, Nilesh, on that note, we're going to wrap up this conversation. Thank you.